You said this Fed is contributing to market volatility. What is it that Chairman Powell did on Wednesday that you disagree with?
So I said it contributed to undue market volatility. Is the undue part, excessive market volatility. Look, I think once again, the Fed did not understand the technicals. Once again, the Fed didn't understand the behavioral aspects of markets. So while Chair Powell went out of his way to be balanced, he did a few things that made the market hear just what it wanted to hear. First, confirm that we are downshifting in December. Second, do this ahead of the labor report, suggesting that maybe he knew something that others did not know. Third, talk about risks being now balanced, two-sided, and bring in his colleagues on the Fed. And then what he didn't mention, John, he did not push back in any way against what already was a significant rally in markets and a significant loosening of financial conditions. So while he said other things, and he was right to say other things, including warning about inflation staying, warning about our job not being done. He didn't realize where the technicals of this marketplace were, and he didn't realize the behavioral aspects. And that's why you got this overreaction, and now we're giving some of it back.
So, Mohamed, the equity market is basically back to where it was at the end of August when we heard from Chairman Powell at Jackson Hole. You talked about that easing of financial conditions off the back of the speech, the address from Chairman Powell earlier this week. Mohamed, do you think that means they have to go even further than we expect? And based on where you think the terminal rate's going to be, when they deliver projections on December 14th, how much higher up do you think that dot in 2023 needs to go?
So, John, it's going to be tricky. They've got a CPI report just before. It's going to be very, very tricky. I suspect that they will guide us to above 5. That's where I think they're going to be going. But this is really tricky. This is a situation where the Fed has to be very careful about what it communicates, because we don't need undue volatility. And when we come to talk about other segments of the market where there are already liquidity strains, we'll understand why you don't want undue volatility in this marketplace.
June projection for year-end 2023 was 380. September projection for year-end 2023 was 460. When we get the projection, Rick, for year-end 23 in December, is that a 5 handle? How much higher does that need to go?
In terms of the terminal rate?
In terms of the terminal rate, Fed funds 23 year-end in their summary of economic projections.
Listen, I agree with how Mohamed chronicled it. I think they've got to get to about 5-ish. And by the way, I was comment on one part, because our last month on the show, maybe I was a bit animated about this because I think it's right. The chair, when he said at the press conference of the FOMC meeting, when he described this dynamic of we can over-tighten and then use our tools to bring it back, and I think I got a little animated. I think that's really hard to do. Unless you break a lot of structures, it's hard to do that. I thought one of the big changes at the Brookings was when he said, actually, we don't want to really do that. That's what some of that volatility was really, because you cut the tail off. And that was a really big deal, i.e. that you could go further and bring it back. That was a big deal for markets. Listen, I would go back to my point. I think they've got to get the funds rate to a level and then let it marinate through the system for a period of time. Put it on hold for a while. It is restrictive where you're gonna pause. And the interest rate tool is one of the most extraordinarily blunt tools today, because it gets at some parts of the economy, not others, and you need to see how it's gonna react. But listen, I think the market's got a little overzealous across a series of things, and I still think they got to go to around 5-ish. But again, I don't think they need to go much further than that until you see the data subsequent to it.
Thank you, Melissa. Look, we are adjusting to the 3 paradigm changes we've talked about on Squawk. The change in the liquidity paradigm, the change in the growth paradigm, and the change in the globalization paradigm. And that was going to be bumpy, but it offered the prospect of a better destination, a less distorted destination. What is worrisome in the last 24 to 48 hours is 2 other things. Is an accelerated loss of confidence in policy making. You've heard the Fed discussion. If you are here in the UK, there's a lot of concerns about policymakers here. So policy making going from being a repressor of volatility to an amplifier of volatility. And then let's not forget what's happening to flows. Bank of America reported 50 billion went into cash funds out of every single other asset class. So we're starting to see those technical dislocation, and even the treasury market is not functioning well. So I'm less worried about the first three things, but I'm spending a lot of time on the final two things because they can create very unsettling volatility, not just volatility.
I want to highlight what you said about the treasury market and your focus on it right now, because the volatility that we've seen, I mean, I haven't seen it before, but you may have seen it before in terms of the huge moves that we're seeing in yields just even intraday. And I'm wondering if you think that there's something that is signaling, because so many people say that there's nothing wrong with the credit markets overall, and that's where they would start being concerned about what the Fed is doing and the impacts.
Yeah, so normally you worry about the peripheral markets, about the high yield market, the leveraged loan market, and you spend very little time worrying about the treasury market. But there are episodes, and you will remember them, May 2013, again in March 2020, when the problem is the safest market, when the problem is the mother of all markets around the world, which is the treasury market. And I can tell you, yesterday's price action and what I heard from people trading that market makes you uncomfortable. So keep a really close eye on the functioning of the market, not the yield level, but the functioning of the market.
What does the curve steepening under these circumstances tell you? We were talking to Sri Kumar before, and he said that he believes that the treasury market, that the yield steepening, the curve steepening, signals that investors are looking forward to beyond the recession to better times, which seems like a very optimistic take, but could very well be true. And I'm wondering what you think it signals, because it seems like there may be certain technical issues that's causing the 10-year yield to go higher and therefore the curve to steepen.
Look, I hope he's right, but it's all about technical issues. A lot of people can't get done what they want to get done. So they're getting done what they can get done. Don't underestimate the amount of suboptimal decisions being made right now because liquidity has become so patchy. So I would be careful extrapolating too much in terms of what does it mean for the economy, because right now, technicals are really in control of quite a few curves.
When we see issues in the treasury market, Mohamed, do we eventually then see the next shoe to drop or the next domino to fall, whatever metaphor you want to use, trouble in the credit markets, trouble in the leveraged loan markets, things like that? Or can it be isolated?
So the treasury market is the one you cannot isolate. You can isolate other markets, but that's the one you cannot isolate. And it's a reflection of structural weaknesses and fragilities that a lot of people have written about. The G30 has written about. The Treasury itself has been looking into it. So this was long in the making, and it was amplified in a major way by the duration of QE and the size of QE. So these are structural. It matters because, remember, if you can't get what you want to get done, you will start spreading contagion. And that's why it matters for the credit market. You start spreading contagion around markets. So let's keep an eye on it. I'm hoping it will pass. I'm hoping this is just short-term, various things coming together. But of the 5 factors, this is the one, along with the loss of confidence in policymaking, that I would keep a very close eye on. The other stuff we can navigate, and we understand how to navigate.